Okay, you mentioned illiquid assets, illiquidity premium a little earlier in our conversation. You have a chapter on it in the book. I want to focus, if you don't mind, on specifically private equity because, well, aside from private real estate, private equity has the largest historical set of data for us to draw some conclusions. So I have long felt, and also I think this is supported by the data, and you do a great job of highlighting this in the book, that the private equity premium, so to speak, is overstated for a variety of ways. Maybe walk us through some of the literature on that, your interpretation of that, and then why, in fact, illiquidity may not even be a risk factor, but that actually maybe flipped around for many investors.
Yeah. But let's start with first sort of applauding that private equity or buyout industry, because they charge high fees and they have somehow managed to add positive returns over the last 30 years.
Agree.
Beyond those fees. And I think the average fees may be of the ballpark when you take all in 5%, and you add a couple of percent for that. We are talking of big money. So somehow they've done extremely well in that sense. But what that leaves for end investors after fees and in the future is the bigger question. And there are issues then on. And by the way, this was for the whole buyout industry. Then when you are thinking top quartile managers, you get even better, but that's always so that's sort of dangerous path to take. I just wanted to start with sort of the positive. The questions that are often raised then are in the literature are where do you compare it to, and that depending on the data set you look at, comparing it to levered equities or small cap value or so on, that may be a tougher benchmark. Or then the other thing is that maybe the world was different until about 15 years ago when this, I would say, Yale model made this private equity investing so popular. And since then, there's been much less evidence of outperformance over public equity. And so I would say that's to me raises a puzzle. So why don't we get an illiquidity premium for something where you lock your money for such a long time? Why it's so modest. And by the way, it's also supported by looking at real estate markets where more liquid REITs tend to outperform less liquid direct real estate and so on. Anyway, so if you buy the argument, which I think is not widely appreciated, that there is actually scant illiquidity premium in those markets, then the question is why? And the answer then is that for any amount of fair illiquidity premium that we might be demanding, we might offset that by our collective love affair on smooth returns, lack of mark-to-market in private assets, not just private equity. And so this feature of smooth returns is something which I think it is a useful feature, but investors shouldn't think that it comes without a cost, because investors then can accept basically lower or maybe even no illiquidity premium. And let me just make it tangible with one example. So if you look at a Cambridge buyout index over if you look at it over the GFC 2007-9 period, it had a 25% drawdown. If you look at the public proxy for it, could be small cap value or something like that, 60% drawdown. So when investors sort of look at it, they I much prefer this. And then then we got the COVID crisis, which was even shorter and didn't make much of a dent to private equity return. So I think many investors then say that, oh, I can sleep so much better with those private assets without mark-to-market, even if they give me no illiquidity premium. I'll still sort of be happy to hold them instead of that damn volatile public equity. So I think that's and by the way, Cliff is taking it even further, saying that there may even be a net illiquidity discount as opposed to a required illiquidity premium. could be. Again, we've got too little data in that area to say it conclusively.
Yeah, I really like Cliff's take on this, and he proposed that public equity managers should have the option of pricing their portfolios every month based on a 3-month delay, or some average, rolling average of underlying prices, to be competitive with the private equity.
We want more than 3 months, to be competitive.
Yeah. Agreed.
They get longer potential lags there. So anyway, yeah,
for sure. I also really like how you highlight in the book that many investors categorize and perhaps even perceive private equity to be an alternative asset class, or private credit to be an alternative asset class, rather than lumping it in with the equity sleeve. But let's all be clear that private equity is equity and private credit is credit. And we should recognize that explicitly in terms of our asset allocation, and recognize that the private nature of it hides a lot of the underlying risk that the public equity version of it exposes.
There's a flip side to that some investors may have limits on how much they can hold privates or illiquid assets, and by focusing on what you just said, would allow them to bypass that consideration. So I think there might be takers to to this proposal.